Good morning, good afternoon, good evening, everyone. Welcome to another edition of our Deal Makers Club, where we highlight great real estate investors and their journey and really giving you guys the insight and knowledge on how real deals are put together. And today we have a special guest with us, Mr. Arthur Kokot. Welcome to the Deal Maker Club today. How are you doing today, sir?
I'm doing well. I'm glad to be on the show.
Yeah, no, it's a pleasure having you here. So I love letting our guests introduce themselves to the audience and really just sharing a little bit about themselves and kind of their journey.
Well, the journey started back in the 80s. Um, when I got out of law school, I joined a firm. I practiced litigation as my legal specialty. Um, and it was a lot of fun. I got to go to court. I got to talk to judges. I tried jury cases. I mean, I did all that stuff. And it was exciting, especially I'd say the first 2/3 of it, and
Okay.
then kind of a sameness entered into it because once you sort of mastered the skills, at least at the level I'd mastered them. I mean, I wasn't going to be Clarence Darrow anyway, so there was going to be just a lot of the same of what I had been doing for a lot of years, stretching into the future. And I kind of and also I was kind of low man on the totem pole in the firm in terms of not being the guy who brought in the clients, but being the guy
Mm,
who did the work. So those guys don't get compensated particularly well. It was fine, but it wasn't great. And
right.
because of that, I also didn't have particularly high influence in the firm because the way firms are structured is the guys who bring in the clients are the guys who run the firm.
Okay.
Okay. And all that kind of inside politics and whatever. So I asked myself the question, okay, you're doing litigation, you're going to court, you're dealing with other people's, claims and aspirations and ambitions and whatever. So the question was, do you want to spend the rest of your career fighting over other people's money?
Mm,
And when I asked the question that way, the answer was kind of clear that there are better ways, at least for me, with my temperament and my skill set. I
okay.
thought I thought there were probably better ways for me to make a living, and there's certainly other ways to skin a cat than to do what I was doing. So that's how the change came about.
Well, awesome. And I think we all have that fork in the road moment, some earlier than others. And I think in your instance, it was definitely earlier in your career. Um, when it came through, was it a family in the picture at all? Was it just you? Were any of those other considerations kind of in the back of your mind as you're kind of making that leap of faith or that transition?
Well, it was actually, I had the advantage of, in that sense, I hadn't started a family yet.
Okay.
Um, I wasn't married yet. I was engaged to the woman I was going to end up marrying, but we hadn't married yet. There weren't any kids yet, so
Okay.
I could, I was sort of freer to take a shot than I would be later in life when you've got, the wife and the kids and the mortgage and the tuition and all the rest of that stuff. So I was kind of ahead of the curve on that. But I wasn't any, but I wasn't that young. I was in my 30s.
Okay. Okay. So what did that move look like for you? So you're looking out, you're like, okay, something else has to be out here for me. This isn't really working out. So what was kind of that process to kind of hone in on real estate and making that
Okay.
transition?
Well, I was living in a rental apartment. Um, my whole nest egg after, a dozen years of working uh, was, basically around $50,000, which,
Okay.
it's more than it is today, but it's not a lot. And I said, what can I do with this? I mean, I can do what everybody does, which is, buy a co-op or a condo and move into it and, and then maybe trade up from that. Um, but I thought that's not really, that's not going to make it, because that's just really that's a side hustle at best.
Right.
So if I'm going to do this for real, I need to buy a building. Now, how do you buy a building with $50,000? I mean, it's like nothing. But if you're going back to 1982 on the west side of Manhattan, you could actually buy, a 4-story, 8-unit, so-called brownstone. Not really a brownstone; it's a tenement, but people in New York like to call them brownstones. I actually could have bought it for less than I bought it for if I knew better, but I was a newcomer.
Okay.
And I overpaid. I didn't know the market at all. I was just, and brokers show you a bunch of houses and and anyway, the advantage of this particular deal, even though I overpaid in terms of gross price, was they were willing to take my $50,000 as the equity.
Okay.
And I got a purchase money mortgage from the seller, so I didn't have to go to a lender. And I had 2 principal pay downs of $25,000 each in the 2 years after closing. So 2 years after closing, I'd have $100,000 in equity. I had to really squeeze out to get those 2 $25,000 principal pay downs, but I did. And by the time I'd been in that building, I guess a couple of years, I'd managed to empty out some other apartments besides the one that was empty when I moved in. And I was able to offer it to a subsequent buyer with a considerable amount of vacant space, which in New York at the time was an advantage because all these kinds of apartments were subject to regulation. And if they were vacant, they had more flexibility. Like if someone, like a user, could move in as I had and use the space themselves, or they could do a renovation or combine units or whatever to get out from under the restrictions, because that was kind of the game. That was a game that owners of real estate in New York City have been playing for years, which is how do you find a way out of the maze that lets you raise the rent to what it really should be, as opposed to these tiny 2% increases from a base that's decades out of date in terms of its relationship to market. So I sold the building in '85, a couple of years after I'd bought it, for 50% more than I paid for it.
Wow.
Okay, and that was the beginning, because and unlike the seller in the first place, I didn't offer any financing. I took my profit in cash. So suddenly I've gone from the 50 that I started with in 1982, I'm up to 200 in 1985. And to me, at the time, that seemed like a pretty good situation.
Right. A great return on your investment in money and time.
Right. So, and then I rolled, and then I got, I was introduced to a guy who, I came totally from a working class family. I had no money. I was introduced to a guy who came from a family that had some money. And the guy's dad had, given him some seed money so that he could play.
Okay.
And so the two of us, I put my couple of shekels in there. He put his. He had some contacts, with people that he could call on to be investors. They put some money in, and we ended up buying investment properties instead of what's called in New York a 25-footer, meaning it's 25 feet of frontage. We bought a 100-foot building. Actually, we bought, what did we do? Actually, that first deal was 2 buildings. We bought a 2-building package. And then we rock and rolled from there, because we had we had a building on Upper Broadway, it was in a minority neighborhood, but it was a prosperous neighborhood. There was a drug problem up there in the upper, on the Upper West Side, the upper West Side in the 160s. But I mean, in terms of, there's stuff happening on the streets where there could be, there was gunfire from time to time. This was the 1960s, which was a rough time, in New York for that kind of activity. So anyway, gangs and turf and all that stuff on the street. But we did well with that building. The one thing that we realized, and I think it was my partner who realized it more than I, because he'd kind of been out there a little ahead of me, is the play with that building was not the apartments, because the apartments were the apartments. I mean, basically, you weren't going to be able to do a whole lot with them except, whatever guideline increases were, according to the New York City. But there were half a dozen stores in that building on the ground level. And all of them had leases that either had expired or were about to expire. And they were rented, they were, your bodega type tenants, a local drugstore, this, that, and the other thing. They were rented for, roughly around, $500 a month. And we looked at what else was going on, because you had setups from other buildings showing what other rents were being paid in the neighborhood. That was our source of income. We figured the rents really should be up around $2,500, or depending on the size of the store, maybe $3,000, whatever. So we raised all those rents. A year after, less than a year, I think, it was about within a few months after we bought it, we were able to go to a lender and refinance the building for a lot more than we paid for it.
I bet.
Yeah. So because we had probably close to I don't remember the numbers anymore because it's been so long, but somewhere between, it might have been close to a 50% increase on the total revenue from the building, because of how big a bite we've been able to take on the store rents. And then by the end, and then it really got interesting. We were approached at the end of the year, close to the end of the year. We bought the building at the end of '85, and guy wanted to buy it by the end of '86, and he said we got to close it before December 31, because on January 1 of 1987 the tax laws change, and yada yada yada, and he wanted it under the old law, not the new law, and and the problem with that was, he wanted to assume the loan that we had just put on the building, which was assumable, but you had to go to the bank. And, we were at that point, we were in like December, and he wanted a December 31 closing. And we were like a week before Christmas. And so he calls, he calls the bank, and the bank says, "What are you, crazy?" I mean, this takes at least 30 days. We're in the holidays. This ain't going to happen. I mean, you're out of your mind. So the guy comes back to us, and we knew that this was the case. And so he had a right to cancel the contract if you couldn't get the assumption. But I remember what I said to him was, "Hey, look, this is a good loan for the bank. It's a great interest rate. I don't know how, if you want to play, I don't know if you want to play guts ball or not, but if you want to play guts ball, buy the building, go back to the bank after the closing and tell them you're the new owner and you want them to sign off on the assumption. And guess what? he bought it.
He did.
Yeah, he did. He was willing to play guts ball on it. We closed, and he went back to the bank after the closing, and they were annoyed because banks, they don't like you going around them,
Right.
but they weren't going to call the loan because it wouldn't have made any sense for them to call a loan. They had a paying loan. They had a new borrower. So they signed, that had, what do you call it? It was a legit borrower. It wasn't that we sold it to
Right.
people. So they signed off on the assumption, and everybody went their own way, and the deal, we sold that building for, I don't know, I think $600,000 more than we paid for it. I think we paid like $1 million. I think we paid $1 million and sold it for $1.6 million. So that's
in less than 2 years.
Yeah. Oh, in a year, in one calendar year. Yes. So that's
great.
So I mean, that's how I was, that's how we got into this business, and it snowballed, So we went from, I went from, 50 grand to, to some, what at the time looked to me like real money.
Right.
And, from between 1982 and 1986.
Yeah, no, I think that's, you said a couple things that stood out to me, and how you guys started creative financing, coming in with the $50K up front, the two $25,000 payments, a couple years later, then moving to the next deal, syndication, bringing in partners, joint venture, that side of it, and then looking at the creative financing with a loan assumption, with being able to sell it, to someone that can assume the loan. And I think a lot of times I see real estate investors, you have those limited beliefs on, hey, I got to have all this money up front for traditional down payment. But if you just bring a little creativity to what you're doing, and you can get to yes a lot of times and make deals happen.
Well, we were lucky. That was a kind of a Wild West kind of, time period. I remember what was going on. We were flipping contracts. I wasn't, but people were, in New York, the thing was, people would sign up a contract to buy a building, and then they'd sell the contract for like $100,000 markup, a couple $100,000 markup. It was really a very rapidly moving market at that time in the tougher parts of the city, because I think people foresaw the trend toward gentrification.
Okay.
Which kind of began then and then really took off. Because remember, the city, if you go back, a dozen years before that, in 1973, the city was broke. In 1986, the city looked like it was on the move.
Okay.
And so and the players, who knew a lot more than I did because I was a kid, that was the mood. The mood was there was cash around, people were rocking and rolling. It was a fun time to be in the biz.
I bet it sounded like it was fun, and I think that's the creativity with the deal. Every real estate transaction is different. There's always a story with every building, every property, whether it's good or bad, but a lot of times the bad it presents as opportunity for, the person on the other side of the transaction. And I think that's the just inherent nature of real estate. So how kind of going through the 80s and, we kind of have, the lump savings and loan crisis as you're going into the 90s, the dot-com bubble in the early 2000s, and of course, '08. How has that journey been kind of navigating some of the economic cycles and ups and downs, over the years?
Well, the real thing for me, because I was still the newbie in this, is to put together, a portfolio, because, so far we're talking about one building. Well, that building came with another building, so I had that. Then we bought three more, all in 1986, 87.
Okay.
And again, we had the same kind of play on a building up in the Bronx on the Grand Concourse near Fordham Road. And it's great building. It was, Art Deco building. It goes back to, I don't know, probably to the 100 years before now, early 20th century. And again, it had that retail play. You had all these stores with short leases paying less rent than they should. And what's interesting about these situations, and this was the second time we did it, is that the buyers, we knew more about the value of the retail than the seller.
Okay.
That's why the deal, was a deal, because he was selling it based on the existing income. We were buying it based on our view of how much room there was between the existing rents and the market. So
okay.
So we did the same thing with that deal, which is within less than a year. We went in there with a kind of it was a tough kind of loan. It was a loan with personal guarantees and all kinds of stuff. Private lender, all that kind of stuff. I was signing notes for hundreds of thousands of dollars. But my signature at that time, personal guarantee, wasn't worth anything because I didn't have anything.
Okay. Yeah.
So I was willing to. I did things then that I wouldn't even dream of doing now, because I had nothing to lose, and now I would. So I don't sign personal guarantees on anything anymore.
I know that's right. You have to grow in the game.
Yeah, but we were a couple of kids, and we were 30-plus-year-old kids or whatever. But we were signing personal guarantees, and then going through the whole thing with the rents and the leases again, and then refinanced it again for more than we paid for it. So
nice.
that's how we were playing. The SNL thing, that you mentioned.
Mm-hmm.
We never encountered, any direct impact from that.
Okay.
I think that, I don't think that the SNLs were concentrated in New York particularly. We were dealing mostly with just traditional savings banks, and the SNLs operated, I think, under kind of a different set of charters. And they were more, I think, in the middle of the country and the rest of the country, and not so much in New York, to my recollection.
Okay.
Or at least we weren't interfacing with them particularly. Then things got. In terms of my personal story, things got complicated. My partner suddenly, my partner who was a guy who was, just a few years older than I was, he suddenly died. And that's that was, in terms of his personal, life, that was a tragedy. I ended up having to, buy out the estate. It got, there was a lot going on in those years. There really was. When I think back to it now, it was like a script. It was like a sitcom.
It can be like that sometimes. And I think a lot of times, people, we talk about operating agreements and kind of thinking through some of those challenges, because life happens. Someone gets a divorce, or someone passes away. It's like, what happens to the real estate in the company? Who's stepping in, and how do the shares flow down? And so a lot of those things you have to think through up front, because life happens, whether it's on the good side or bad side for us.
It does. And I'll tell you, it's funny because before I bought that first investment property, we were in contract on the first investment deal that that my partner and I were going to buy. And I remember I woke up in the middle of the night in a cold sweat. I was scared to death. I just signed a contract. I was going to have to come up with, hundreds of thousands of dollars. Turns out we canceled that contract, which was good because the building we ended up buying was a much better deal than that one. We would not have been able to, to parlay that first building into a considerable profit the way we did the second one. So, whatever. But, and then, eventually settled everything with the estate. I ended up with, with the property, with in my name at that point.
Okay.
And then I wanted to get into a different kind of property. Because these were large buildings, but they were in tough neighborhoods. I wanted to buy smaller buildings in Manhattan, in better parts of Manhattan, where you could take advantage of the trend that I mentioned earlier toward gentrification. So, what the deal was there is you could buy, a building about the size of the one that was my first purchase.
Okay.
But with a lot of upside. And the upside being that all of the rents, and here we're not really talking about retail anymore. We're talking about apartment rents.
Okay.
All the rents are very low. They're all regulated, but you can see your way to getting value out of those buildings because there's turnover. I mean, there are some people who never got that. They didn't care. They weren't in the business. But I remember, somebody had tried to, get to be a what do you call it, a money guy for me, and he said, "Nah, you're never going to go anywhere with these buildings because people stay there forever, and and the rents go up 2%, and what's the point?" And he was not. He couldn't see the idea that isn't the case. The case is there is turnover. So I mean, I bought a whole string of these buildings. At some point, I must have had about 300 units.
Okay.
When I held those buildings for many, many years, I bought them starting in the 90s, and I held them until about 5 years ago.
Okay.
And in those 300 units, over the course of 30 years, I ended up with 200 vacancies, which means
okay.
one way or another, I got 2 out of 3 apartments vacant over the course of 30 years. And those apartments, I was able to renovate and, get rents, that started at, again, your $500 kind of baseline, and some of them lower than that. I mean, I had rents in double digits, like
Okay.
less than $100. But those apartments, once you gutted them and rebuilt them, and when I'm talking about rebuilding, I mean everything. I mean, you're going down to the studs, you're going down to the bricks, you're going down to the joists. There's nothing left. You pull everything out of there because it's all 100+ years old. It's all shot. The layouts are no good. You need to basically operate only at the perimeter of the building, and everything else has to be new, which means you're going to put down, a new subfloor. You're going to put in totally new wiring. You're going to put in totally new plumbing. You're going to put in sheetrock on all the walls and take off the old, plaster chunks of plaster. You're going to put a new ceiling in. You're going to put new lighting in. You're going to put a new bathroom, new kitchen. Basically new. You're going to spend somewhere, depending on how big it is and whatever. Maybe you can do it for 20. Maybe you can do it for 25. Maybe you can do it for 50. but you're going to go from a $500 rent to $2,500, or you're going to go from $1,000, to $4,500 or $5,000, and suddenly you've created huge value.
Yeah, that's phenomenal.
Because
I know we tried today.
Yeah.
Try to make your money back on renovations in less than 48 months, but you're making all your money back in 1 or 2 years.
Yeah, and those buildings, I was buying those buildings for $500,000 or less a pop. I mean, I'm talking about a whole building for $250,000, $275,000, $500,000. Numbers like that, basically what, think of it today, in today's market, it's pocket change.
Right.
So that is, being look, in a rising market, everybody's a genius.
Right.
I had the huge good fortune of being in the right place at the right time. You can't do that in normal times.
Right.
You can only do that when the market's going off like a rocket ship.
Yep. And you have to take advantage of it. That's awesome. That is awesome. And I think that's the thing, that being able, like you said, right place, right time. And that's a true blessing. And being able to take the action. I think that's the other part, is like, so many people have the opportunity, but like, are you going to seize it? Are you going to move and, and take action on it? And because some people may say, hey, they get the one building, they get complacent, but it sounds like you had the vision and you could see what the possibility was. It's like, hey, I can repeat this over and over and over again and build considerable wealth.
It got to be easy. I mean, I remember, like I said, that first one that I went to contracted that I actually never ended up buying. I woke up in the middle of the night in a cold sweat. Years later, I was, by the time I got married, had kids, my wife had asked me, so what'd you do today? And I said, I bought a building. And I say it like I bought a pair of shoes,
Yeah, no, that's awesome.
So it was fun. And that ride, in one way or another, it slowed down, but it's kind of, it sort of lasted, that portfolio that I was sitting with until around the year 2000.
Okay.
And what happened then is, in 2019, as a reflection really of the economy, politics, what have you, the New York legislature, which controls these rent regulations, it's not really controlled from the city, it's controlled from the state. They rewrote them, and they basically said, we're done with gentrification because too many low rent apartments have come off the market, and there aren't enough low rent apartments, and we've got an affordability crisis. So we're done with this. And essentially what they did is they abolished, what people, like me had been doing for decades. And they said, you can't do it anymore because you can no longer pass those renovation costs along to the tenants in the form of rent increases beyond some tiny, $30, whatever, which didn't do anything for anybody. So my question was, okay, where the heck do I go from here? And I did not really want to just hold these buildings in a passive kind of way, and just sort of collect rents. And particularly because at the same time, what was going on is the value of these buildings had spiraled downward, because they'd always been, the value in New York, real estate of this kind had always been based on the assumption that you would continue to appreciate, that they would continue to appreciate in value because you could continue to raise rents at market rates. Well, once that model was gone and the futures weren't there anymore, then suddenly you've got a whole different way of valuating, and cap rates, go crazy. So, instead of buying something at a 4 cap, now you're buying something at an 8 cap. The value has just gone to nothing.
Gotcha.
Well,
Yeah, that's a considerable jump.
well, I wanted to get out before that happened. I mean, I didn't completely escape, but I got out before the worst. And
Okay.
I rolled over almost the entire portfolio into a different kind of into a different sector. I sold all those buildings. You know, some of them some of them were in a blanket loan. I sold those in a batch. I sold the others, you know, individually. So over the course of 5 years, I sold about 18 buildings and rolled all of them over into industrial property in the Midwest of the United States, which is a whole different play. It has nothing to do with what I've been doing. You're basically
Right.
you're buying a vanilla box, the kind I was doing, you know, rented to mostly to credit tenants, and you know you've got, you know, triple net leases where the tenant is responsible. You're not worried about you leaky faucets anymore. Instead of having 300 residential tenants, you know, I've got, you know, 10 corporate tenants. It's a whole different game. And I'm an old guy now, so I don't want to, you know, I want to take it a little easy. I'm gonna
Okay.
I'm gonna pass this on to my kids. I'll let them run it.
Most definitely. That is awesome. So when you transitioned the portfolio, did you leverage the 1031 exchange for those?
Every single one of them was a
Okay.
1031. So that's how I was able to, you know, to take that, you know, go from 1982 with $50,000 to now, you know, a dozen, you know, I've got $1.5 million square feet of industrial property now.
Nice.
It's worth a little more than $50,000.
Right, right. It definitely is. And I think that's the big one that as I talk with more and more investors that are transitioning out, that are leveraging the 1031 process and deferring the capital gains and really setting up for their legacy for the next generation
Yeah.
and taking a step back because it's been a heck of a 40-year run. And now you're able to just sit back on your laurels and reap the benefits for, you know, the deals and everything that you've done. So salute to you. That's phenomenal job well done.
Well, thank you. It's been fun.
Yeah, no, and I think for you and kind of making that decision, I think the regulations, you saw the writing was on the wall kind of 2019 with those changes for you. For other investors that have, you know, been successful and kind of going through, was there anything with kind of the lifestyle or like want to just take a step back, you know, are you looking for like for golf, you know, spend more time with grandchildren? What was it? It was like, you know what, it's time to, you know, to look at maybe, you know, letting real estate go and go into more passive than active real estate investing.
Well, I think it was mostly I mean, to some extent, you know, it was motivated in terms of, you know, personal time. Although I got to tell you, the industrial stuff keeps me busy too in a different way.
Really?
You,
Okay.
yeah, you got, you know, I mean, I've got a property manager, obviously, but you know, the leasing and you know, and the financing and the buying, you know, the purchase and the sale, that still ends up on my plate. But
Right, right. Okay.
the real motivation was to get out of New York before the value of those properties, kind of tanked to the point where I would have much less to show for all those years of having worked in that vineyard. So that was the point. I mean, I would have timed it better if I'd sold everything in 2017, but I wasn't smart enough to do that.
I got you. I got you. Well, I'm glad it all worked out for you. And kind of as we wrap up the interview, this has been phenomenal. You know, this is why I really love to do these have these conversations, just really to gain that insight and wisdom. And today, really get smarter on the history of New York real estate and just kind of that process that the area went through and how real estate investors navigated during that time. But from your standpoint and leaning back over your years of experience, what do you think separates those investors who succeed long term from the ones who maybe burn out or quit?
Well, I mean, I think you got to start with kind of some basic business sense, common sense, And I don't know, I mean, I don't know, maybe you're just, maybe you're born with it. Maybe you can learn it. I don't know. But I think you need to have some kind of feel for the kinds of property you're buying. You know,
Okay.
I think you need some kind of level of understanding of, you know, what of how the how the whole thing works. You
Right.
know, of, you know, what location is going to be superior. You know, what kind of, you know, configurations of units is going to be superior. Being able to tap into some, you know, some cash in the early days when you don't have it yet in some way, or as you mentioned, you know, be creative so you can stretch the little bit, the you know, the few shekels that you do have. But that, I think, is kind of the beginning of whether you're going to be able to do it. And you've got to be willing to take some risk and do some tap dancing, because, you know, I there's no way I could have done, you know, what I did if I didn't, you know, do some things that I, you know, in the early days that, you know, I wouldn't even think about doing today, like signing probably $1 million in personal guarantees. I mean, I you know, I didn't have $1 million, so what was the difference?
Right.
You know,
No, that's phenomenal.
so that, and then the other thing is, and I really think this is totally crucial for, and it has always been crucial.
Okay.
Don't over leverage.
Mm,
You know, I
okay.
always used leverage, but I never over leveraged. I was never in a situation where I couldn't pay the loan. But if you get yourself in a situation where you can't pay the loan, you're going to lose the property, and that's
Right.
happened. That's happened to much bigger guys than me. So you got to be careful, because you know, if you, I mean, I've seen people, you know, end up in you know, in bankruptcy, literally, because they over leveraged. You know, they lose, they, you know, they, and then they lose everything.
Mm. No, I think that's a great one. That is great advice. That over leverage, because you can be aggressive and it goes both ways. That, hey, it can work in your favor, but when it doesn't work in your favor, it can get ugly quick.
Yeah.
Well, also, well, no, this has been a pleasure. I really enjoyed the conversation. Hopefully, for you as well too. And I know our audience definitely they're going to walk away with some nuggets and they're going to be wiser for it.
Okay.
So definitely want to say thank you.
I've enjoyed it, Johnny. Appreciate the opportunity. Thank you.
So, well, it's great having you on here, Arthur. Thanks again, everyone, for tuning in to today's Deal Makers Club podcast. Today's conversation was a reminder that real wealth isn't built overnight. It's built through relationships, discipline, and staying in the game long enough to recognize the right opportunities. So, Arthur, thank you again for sharing your journey, your lessons learned, your insights from the trenches of real estate investing. And to everyone listening out there, whether you're closing on your first deal or scaling your portfolio to the next level, keep learning, keep building, and keep surrounding yourself with people who elevate your vision. I'm Johnny Lynham, and this is the Deal Makers Club podcast, where deal makers connect, grow, and build lasting wealth. We'll see you on the next episode.